Okay. Okay, sources of financing, equity and debt. So this is about getting money for your business. Okay, capital refers to how a business is financed. Two major sources of capital, equity capital and debt, borrowing money. We'll go into those more. Raising capital to start or expand a business is a challenge. Many entrepreneurs are caught in a credit crunch. It can be very difficult to get access to capital. Financing needs to be in the $100,000 to $3 million range. Financing in that range is the most challenging to fill. So if you're looking for, say, less than 350,000 reals, often you can talk to 10 relatives and 10 friends and maybe be able to come up with the money. Anything beyond that, it's generally you're going to a bank. Okay, secrets of successful financing. Choosing the right source of capital can be as important as choosing the right form of ownership or the right location. The money is out there, you just have to know where to look. Raising capital or raising money takes time and effort. Creativity counts. Entrepreneurs have to be as creative in their searches for capital as they are in developing their business ideas. Okay, the internet provides sources of information that can lead to financing. Use social media to help find potential investors. Be thoroughly prepared before approaching lenders and investors. So what's one way you can be very prepared before you approach a lender or an investor? Any thoughts?
Sorry, can you ask the question again, David?
Okay, how can you be well prepared before you talk to a lender or an investor about them lending you money?
By the plan?
Yes, having a good business plan. They're going to want, first they might want just a conversation with you, then they're going to want to see the business plan, then they're going to want more conversations.
And there's something else that was mentioned in other classes where you can show them that you can contribute to the business by taking half of the business on your own and maybe asking for money for the other half to show how you care about your own business.
Right, so you're investing in your own idea. And that's also very, very important. Okay. Entrepreneurs cannot overestimate the importance of making sure that the chemistry among themselves, their companies, and their funding sources is a good one. So you all have to have a similar mindset. Plan an exit strategy. How and when the lender or investor will be repaid and what is their return. Entrepreneurs should look for many sources to find the financing they need to launch their business because you want to find the best offer possible to you. Layered financing, putting together capital from multiple sources. So it doesn't have to just be one person. But if you do have multiple investors, you should let them know that there are other investors. Okay, so 3 types of capital. Fixed, used to purchase the permanent or fixed assets of a business, building, land, equipment, and others. Working capital, used to support the small company's normal short-term operations, buying inventory, paying bills, wages, or salaries, and others. Growth, used to help the small business expand or change its primary direction. Okay, then equity capital represents the personal investment of the owners in the business, and that's what we just mentioned, right? So your own money into your own business. Also called risk capital because investors assume the risk of losing their money if the business fails. It does not have to be repaid with interest like a loan does because it's your own money. If an entrepreneur brings in other investors, the entrepreneur must give up some ownership in the company. Potential for high returns to investors if the business succeeds. Okay, debt capital. That's borrowed capital or borrowed money from a bank, for example. Must be repaid with interest. A liability on the company's balance sheet. Can be just as difficult to get as equity financing, even though there are more sources of debt financing available in the market. So there's lots of banks, but generally they all act the same. Can be expensive. The interest rate can be high, especially for small companies because of the risk return. Suitable if the entrepreneur does not want to give up any ownership of the company. Okay, sources of equity financing. So personal savings, your own money, friends and family members, crowdfunding. These are websites like GoFundMe and those kinds of things. Angel investors, those are people who kind of know you or through friends of friends, and they invest money in businesses they like. And think of it as an angel. They're generally have less requirements of a bank or a venture capital company, which is below. Bringing in a partner. So having a partner, they can bring in their money. Corporate venture capital and public stock sale, going public. And we discussed those in the previous chapter. Personal savings, the first place an entrepreneur should look for money. The most common source of equity capital for starting a business. Outside investors and lenders expect entrepreneurs to put some of their own capital into the business before investing theirs. Okay, sources of financing for a typical startup business. Okay, owner's equity, then the green one, then below, insider equity, family and friends. Outsider equity, angel investors, venture capitalists, corporate, government. Owner's personal debt, so he took a personal loan. Insider debt, friends and family, they took loans for you. And then outside debt, bank loans, credit cards, credit lines, personal loans, and other loans. After their own investment, many entrepreneurs turn to those most likely to invest in their business, friends and family. Be careful. Expectations and risk should be clear. Beware of possible damage in personal and family relations. So if you borrow from a family member, every time you have a family function, that family member might drive you crazy, always asking about your business and how things are and how their investment is, and there's a cost to that. Okay, choose your investor carefully. Keep the arrangement strictly business. Prepare a business plan. Settle the details up front. Write a written contract. Treat the money as bridge financing, temporary until a long-term source of capital is found. Okay, so then you pay them back and they're out of your business. Develop a payment schedule that suits both partners. Have an exit plan. Okay, crowdfunding, the practice of funding a project or business venture by raising many small amounts of money from a larger number of people, typically via the internet. Use the power of social networking. Allows entrepreneurs to post their elevator pitches and proposed investment terms on specialized websites and raise money from ordinary people who invest as little as $100. The amount of capital sought tends to be small, less than $10,000. The returns for investment are often tokens, discount coupons, or free samples. Okay, so what's an elevator pitch? Can somebody tell me what that is?
Is this the quick chat in the elevator, like to sell your idea?
Yeah, so imagine you're in an elevator and you get in with somebody and you just decide to have a conversation, and they ask, what do you do? And you're going from the ground floor to the 30th floor. So maybe you have 30 seconds to a minute to tell them exactly what your business is about, to enough degree that they want your phone number to talk about this more. Okay, so it's the shortest conversation you can have that gets somebody interested in your business. And that's a very important speech to make. Angel investors.
Sir, what did you say? What did you say? Elevator what?
Elevator pitch. So elevator pitch is like a sales pitch that happens in an elevator where you just randomly talk to somebody. This is the hypothetical scenario, and you only have 30 seconds to explain your business. And having this pitch, this sales conversation about your business, having a 30-second version is very important because you're going to meet a lot of people who don't have much time. You just kind of walk by and chat with them for a minute. And having that pitch, when they say, so what do you do? Being able to say it within 30 seconds keeps them from being bored if they're not interested, but might be just enough that they ask for your phone number to talk about it more, to become an investor. Okay, angel investors, wealthy individuals who invest in startup entrepreneurial companies in exchange for equity, ownership stakes. An excellent source of patent money. They are willing to wait for, patient money. An excellent source of patient money. They are willing to wait for repayment or return. For investors needing relatively small amounts of capital, typically ranging from 100,000, sometimes less, to as much as 5 million. Okay, willing to invest in the early stages of a business. So these are the kind of investors who really want to see you succeed. They kind of like the excitement of being an investor, and they want to see some kind of return, but they're very patient about it. Okay, and this could even be something like the president of a company you used to work for, who's very wealthy, and now you're doing your own thing, and you keep in touch with him, and he likes your new idea, and he wants to be an investor in your business. Could be your neighbor, and he sees you as a young business person trying to get something done, and he wants to help. That's an angel investor. An estimated 318,000 angels across the United States invested $22.5 billion a year in 66,000 companies. Okay, their investments exceeded those of venture capital firms, providing more capital to 18 times as many small companies. So they're just people doing their job. They own companies. They maybe have an inheritance. They're just wealthy, and they want the excitement of being a part of somebody else's business. Okay, and they're great people to know. Angels fill the gap in the seed capital market, the startup money market, specifically in the $10,000 to $2 million range. Okay, average angel investment is $50,000 in a company that is in its seed or startup growth stage. Typical angel invests in one company per year, and the average time to close a deal is 67 days. That means they decide whether or not they're going to invest in you within almost 2 months. 52% of angels' investments lose money, but 7% produce a return more than 10 times their original investment. Angels often invest in industries which already have experience. They already have experience and ownership position, so they understand what you're doing. Okay, the challenge: finding them. Use connections, network, and ask for an introduction. Look nearby. So this is like a 75 to 180 kilometer radius. They use miles here because it's American. 7 out of 10 angels invest in companies that are within 85 kilometers of their home office. Okay, so for Qatar, it's almost anywhere in Qatar they could be. Okay, informal angel clusters and networks. 340 angel groups across the U.S. So these investors are also sometimes have their own little clubs. And then the internet. Okay, angel financing. Amount invested in billion, number of companies. So from 2002 to 2011, it was rising quickly from 2002 to 2007. The recession happened, but even with the recession, they kept investing to a greater degree than which the recession hurt the economy. Okay, and then it started to pick up again. And now they're investing in more companies now than ever. Okay, partners, having a partner. So we discussed that previously. Giving up personal control, you dilute or you have less ownership. Sharing profits, and for every penny you get in the door, you have to give up something. Otherwise, why even be a partner? Okay, venture capital or VC companies. Private investment companies that bring groups of investors together to find investment opportunities. More than 400 venture capital firms operate across the U.S. Most venture capitalists seek investments in the $5 to $25 million range. Target companies with high growth and high profit potential. That's who they are looking for. Business plans are subjected to extremely rigorous review. Less than 1% of investment proposals are accepted. VC companies may act as advisors to the companies they invest in. So if you do get a VC, they're going to probably force you to have a board of directors, and they're probably going to ensure that they're well represented on that board of directors who vote on how the company is going to operate. Okay, the business plan funnel. 100 business plans come in, 10 are a good fit and promising, and they get a closer look. And then after that, 1 gets funded. This is how a VC looks at things. Venture capital funding. Okay, the amount in billions is the green bars and the number of deals. So 2000, that was the height of the dot-com bubble. Okay, so all the internet stocks and stuff. And then it crashed and then slowly went up. 2009 it dipped again and then went back up. Okay, so these peaks, ups and downs are all pestle related. What's driving the economy, and then most capital companies follow what's going on with the economy. Okay, most often venture capitalists invest in a company across several stages. On average, 96 to 98% of venture capital goes to early stage development, so new companies. Expansion stage investments, companies that are in a rapid growth phase. Only about 2% of venture capitalists goes to business in the startup or seed phase. Okay, that's the very, very beginning of the company. Okay, angel investing and venture capital investing. So the blue is angel. Seed startup, it's almost all angel investors. The middle one, early stage, they're about even. And then later when the companies start to grow, mostly it's venture capital making larger investments into the companies. What do angel investors and venture capital companies look for? Competent, capable management. So that's the people. Competitive advantage. What do they have over the competition? Is what they're doing in an industry that's growing. Okay, do they have a good exit strategy? And intangible factors. Okay, it could be personalities. Things that can't be measured. Corporate venture capital. Large companies that invest in smaller companies. Often in the same industry, invest for strategic and financial reasons. So some companies need a supplier, and say they have a supplier but they don't like their supplier, and a new guy comes across proposing to start a business where he could be a company's supplier. Well, the larger company might invest in that new supplier to get them started, so there's more competition in the market. About 300 large corporations across the globe invest in startup companies. Approximately 14% of all venture capital invested is from corporations. Capital infusions, that is money lent, are just one benefit. Corporate partners may share marketing and technical expertise. So examples, Google, Amazon, Walmart, Cisco Systems. These could all be larger companies that invest in smaller companies. And then finally, going public. Offering ownership shares to a public through a stock exchange. The IPO, the initial public offering, when a company raises capital by selling shares of its stock to the public for the first time. Since 2001, the average number of companies making IPOs each year is 134. Usually only available to larger companies with a proven history of sales and profits, usually more than 25 million in annual sales. Okay, so here's a chart on the history of IPOs from 1981 up to 2011. Okay, so in billions raised is in the green, so it's kind of all over the place. And the peak was around 1996, and then the bottom was around 2003, 2004. Okay, so I can't see any relationship to what's going on economically, but it's up and down, up and down, up and down.
David, can you go to the previous slide, please?
Sure. Okay.
Last point.
Usually
Yes.
Usually only available to larger companies with a proven history of sales and profits, usually more than 25 million in annual sales.
Yeah, but I experienced here in Qatar some of the companies when they go on public for shares. Some, I'm not saying all, because they are losing and they want to collect money from the shareholders in order to recover.
Okay, so
is this possible?
I guess it is possible, but who wants to buy shares of a company that's in financial trouble? So their share price might be under a low value, and it's kind of seems kind of like a desperate move to raise capital if your company is not doing well. But if your company is doing well and you go public, more people are going to want to own a part of you because you're growing. So then you get more money. So I guess it could happen both ways.
For example, here with the airlines companies, they're usually known for a lot of money and a lot of profit. But now with the crisis, they are taking and accepting more investors with the promise of the return on their investments. So usually it's not only for a desperate move. It's usually also can be a part of like a global crisis that can make them go for that too.
Right. So that can happen, but that might not necessarily happen in the stock market. That might happen in the equity. Sorry, not the equity market. The capital market, where in order to continue existing, Qatar Airways, for example, might need a $400 million loan. Okay, so they go to the capital market offering bonds at, say, a higher interest rate than what the banks are offering. And they have to offer a higher interest rate because they're not as secure as a bank or a government bond. So the interest rate or the return is reflective of the risk. So it still is wait 1 second. So the interest rate is a reflection of the risk. So when they go to raise money, they have to offer a return on investment that's relative to the risk. And if the interest they're offering is too low, nobody's going to invest.
Yeah, exactly.
Right. Okay. And to go public on a company that's losing money and doesn't have a future, very few people are going to buy the stock. But Amazon, for example, had lost money for over 20 years. But people kept investing in the stock because they saw it as the future. Okay. Any other questions? No? Okay. Okay, successful IPOs. So launching your company into a stock market. Consistently high growth rates. So every year they're doing better and better. Scalability. The company can grow efficiently. That means if they want to raise, $200 million, they can take the $200 million and grow their business even faster. Okay, a strong record of earnings. 3 to 5 years of audited financial statements that meet or exceed standards of security regulators. Okay, solid position in a rapidly growing industry. The average company age is 10 years. Sound management team with experience and a strong board of directors. So these are some of the criteria of what successful companies have in common when they go to the stock market. Okay, the advantages of going public. Ability to raise large amounts of capital, improved corporate image, improved access to future financing, attracting and retaining key employees, using stock for acquisitions, so they can sell more stock to get money. Okay, and listing on a stock exchange. Being listed on a stock exchange is kind of like a marketing thing too, because your name gets more known. Okay, disadvantages of going public. Dilution of the founder's ownership, which means you have less control of your company, which is the second point, loss of control. Loss of privacy because the company has to do more reporting. Detailed reporting must be provided to the securities regulator. It's expensive to become listed on a stock exchange. You need lawyers, accountants, financial professionals. Okay, accountability to shareholders. So shareholders have rights too. Pressure for short-term performance because the shareholders want to see the stock price go up. And it takes a lot of time. Okay, nature of debt financing. Okay, debt is borrowed money, capital. Debt financing is a popular tool used by entrepreneurs to get access to capital. Borrowed capital allows entrepreneurs to maintain complete ownership of their business. So if you take a bank loan, the bank doesn't want part ownership of your business. They're just giving you the money for a return on their investment into your business. Debt must be repaid with interest. Small businesses are considered more risky than corporate customers. The prime rate, that's the central or the country's central bank lending rate. The prime rate is the rate a bank charges its best and least risky customers. Okay, most small businesses will pay several percentage points above prime. The higher the risk, the higher the rate. So it depends on their evaluation of you. Okay, small business financing strategies. For a small business, the number one is bank loan, retained earnings. So money that you've saved from previous years of business. Then credit cards, vendor financing. So vendors letting you pay your invoices later. Friends and family, leasing things instead of buying. So you rent your location instead of buying the location. Small business administration loan. So you can get, the small businesses have access to some loans. Asset-based loans or factoring. Has anybody heard of the term factoring? Okay, let's say you have $1 million riyals in accounts receivable. You can take all of those invoices, the accounts receivable, and sell them to a company who will pay, at best, they'll pay you 80% of the value. So you have $1 million riyals in receivables. They'll give you 800,000 riyals, and then they'll take the receivables and they'll be very aggressive and collect the money from the people that used to owe you money. So you're selling your accounts receivable. Okay, private placement of debt and other. Okay, sources of capital debt. Commercial banks. Usually the first choice of lenders for small business. So these are the main banks. Average micro, that's a tiny business loan, is $7,400. Average small business loan, $181,000. 12% of entrepreneurs receive bank loans to start their business. Banks are concerned about risk, especially after the credit crisis of 2008. Many small business financing applications are not approved. That means many people who apply for the loan don't get it. Okay, sources of debt capital. Short-term loans, less than a year. Home equity. So you put your home as collateral to a loan. Commercial loans, lines of credit, floor planning. I've never heard of floor planning. Intermediate and long-term loans, more than 1 year. Installment loans, term loans, example mortgages, financing equipment. So you buy a piece of equipment and you get it financed. That means you can take a year or 2 years to pay out to buy that piece of equipment. The term of the loan for how long depends on the purpose of the loan. Short-term purposes should use short-term financing. Long-term purposes should use long-term financing. 6 common reasons bankers reject small business loans. 1, they don't make small business loans. Okay, so you have to do research, okay, to find out the banks that do. I don't know enough about your business. Okay, so they didn't have a good business plan. You haven't told me why you need the money. So what are you going to do with the money? That has to be in your business plan. Your numbers don't support your loan request. Include a cash flow forecast in your business plan. So the financing part of your business plan, or the finance part and the accounting that you show, is very important. You don't have enough collateral. Be prepared to pledge your company assets or even your personal assets as collateral for the loan. Okay, your business does not support the loan on its own. Be prepared to provide a personal guarantee on the loan. Okay, asset-based lenders. Businesses can borrow money by pledging as collateral, otherwise idle assets, accounts receivable, inventory, and others. So you can have your equipment. So basically you take a loan, and if you don't pay the loan, the bank takes your equipment and auctions it off. So there's pros and cons to that. advance rate, the percentage of an asset's value that a lender will lend. So if you have some equipment worth 2 million reals, they might think in an auction, I'm only going to get 1 million reals for it, so I'm going to give you a 1 million loan, even though your asset's worth 2 million. Okay, asset-based borrowing. Discounting accounts receivable, so that was the factoring. Inventory financing, purchase order financing. So you can borrow based on inventory you own, but you always risk if you don't pay the loan, your inventory is going to get seized and auctioned off. And rarely is it auctioned off at a good price. Okay, other sources, vendor financing, equipment suppliers, commercial finance companies, saving and loan associations, and stockbrokers. Okay, credit unions, it's similar to a bank, not applicable in Qatar, but in Canada and the United States we have credit unions. They're similar to banks. Private placements, small business investment companies, small business lending companies, government, public sources. So government has financing agencies. Okay, Qatar, state-sponsored financing and funding programs. So you have QDB, Qatar Development Bank, a Qatar Foundation Initiative, Qatar Technology Science Park, Qatar Business Incubation Center, and Enterprise Qatar. These are some local sources. Okay, QDB provides loans at subsidized interest rates to small businesses. Okay, under its L, can somebody pronounce that for me? The Hamin program?
الضمين.
Okay. Okay, the bank guarantees up to 85% of commercial loans, limited to 15 million reals for small and medium projects. Other banks have joined the program, including Qatar National Bank, which launched its business banking platform in October 2013. So these are things to look into. Qatar Science and Technology Park. Proof of concept fund grants don't have to be repaid, so it's kind of free money for Qatar researchers to demonstrate the technology of commercially viability of their innovations. It helps them to move their technology from the lab bench to the point that commercial investors are ready to back it. QSTP does not gain any ownership over the intellectual property. So this is part of Qatar trying to develop technology in the country. New Enterprise Fund provides capital for startup technology companies located at the Qatar Science and Technology Park. Okay, Qatar Business Incubation Center, joint venture between the Qatar Development Bank and the Social Development Bank, part of the Qatar Foundation for Education, Science and Community Development. Equity for startups up to 300,000 reals. Okay. Additional support for businesses is often challenging early phase of operations through its Jadwa program. Will subsidize, this is Enterprise Qatar, will subsidize consultancy services for audits and accounts while covering 70% of feasibility study costs. Okay, other methods of financing, factoring accounts receivable, selling accounts, so we mentioned this twice already, leasing, assets rather than buying them, and credit cards. Conclusion. Capital is key for entrepreneurs. In the face of a capital crunch, businesses' need for capital has never been greater. Sources of capital may include family, friends, angel investors, initial public offering, that's the stock market, traditional bank loan, asset-based borrowing, and government loans. And we made it. Okay, any questions?